fund manager for PMS AIF at ICICI Prudential AMC, brings a wealth of experience and a unique perspective with a deep understanding of market dynamics and a proven track record of performance. He will share insights into the blend of intuition as well as data-driven decisions that can consistently outperform in the world of equities. So let's welcome him with a huge round of applause to the podium, Mr. Chockalingam Narayanan. Warm welcome, sir.
Thank you, Aishwarya. Thanks to PMS AIF World for providing us this opportunity. Thanks, Kamal. Very good morning to one and all. I'll try and cover the aspects with regards to the art and science of beating the street. I'll try my best to how we do it, how we've been trying to do it, and probably walk you through some of that process. It's like the topic suggests, it's both an art and a science. There's no one way to it, and because it's a behavioral aspect as much, it keeps evolving. So to that extent, one has to be very clued on with regards to that particular strategy of how you do it. But always keeping a certain discipline helps. I'll try and cover those things. But before that, just as a outset, who are we? I'm part of ICICI Prudential Asset Management Company. We are the fastest growing alternatives platform in the country. As we speak, we are close to about 35,000 crores of assets under management in this space, spread across long only, long short, and private credit, and now we are also into real estate. So a whole gamut of offerings for your HNI and ultra HNI clients. We've been able to tailor solutions. Hopefully, you can, if you've not experienced any of these other offerings apart from just the equity products, would suggest if you can, through PMS AIF World, can engage on the other strategies as well. This is where, how do we set us apart from the rest of the asset managers in the country? What we bring to the table is something very unique. We work with what we call as boutique within an institution. We have all the institutional frameworks in place. We have a top-of-the-line risk management team. We have a top-of-the-line operations team. Huge sales force, which is in place, and on top of it, we have a independent investment management team which functions like a boutique. So in that sense, it's a very, very so you get the benefits of a large institution, but you get the nimbleness of the product and experience and solution being that of a boutique. So that's where we stand apart from the other asset managers in the country. We're fairly long-term oriented. So the three things that we typically look for is original research, long-term orientation, and so longevity of ideas is something that we typically boast of. So if you kind of look at our churn levels, it will ideally be pretty somewhere between the 25 to 40% ranges on an annual basis. Average is what we've kind of seen over the last few years. So in that sense, we've been very, very long-term oriented in that sense with regards to the portfolio, and obviously owning high active overweights in the portfolio. So this is what we set out for. Sorry. So that's something with regards to ICICI, and our biggest backbone and strength that we have is our large research team. The large research team is we have almost an army, I would say, of just research analysts of almost about 35 in number, that tracks about 600 stocks in the country today. So out of 2,500 stocks that are actively traded in the market, our team has coverage on about 600. This is the widest coverage that you will see. How this helps us is, unlike the other AMCs which are smaller in nature, which don't have a large research team, this research bandwidth allows us to focus on three simple things. It doesn't matter, end of the day, for you to create wealth in the portfolio, you only need stock returns, and stock returns is a very simple formula: price equal to EPS into PE. So you need earnings growth. For PE to re-rate, you need ROE improvement. If you get these two, ROE improvement and earnings growth, you've identified a good company. But for it to become a good stock, you also need the right set of valuations. So that's where the combination is required. That's where the aspect of having a large research team. So there are no biases towards not wanting to own public sector, or not wanting to own B2B companies, or not wanting to own a certain sector of stocks. We don't have any of those biases. Irrespective of the ownership of, whether it's a public sector, private sector, MNC, or it's a professionally, run company with no major identified shareholders. Irrespective of that, as long as they have these traits, we bring them into our fold, identify them through our BMV philosophy, and get it into our portfolios. That's how we do it, and our biggest backbone, like I said, is our research team, which is quite an army in itself. Now, coming to this, topic of art and science of how to navigate the markets, we look at it on three phases. One is earnings, second is economics, and third is emotions. The three E's, like we would like to call it. Economy, suffice to say that we are today the, almost a $3.8 trillion economy. We are the fifth largest. Probably in the next 2 to 3 years, we become the third largest in the world. And growing at probably the fastest pace among the large countries in the world. So this is basically like saying you're working in an environment with a tailwind behind you, which means that once the economy is moving in the same direction as you are trying to move on, then it becomes easier. If you're trying to move in a direction where the economy is not moving, then you're working against a headwind. So to that extent, it's a it's a great place to be as far as being in India is concerned. Second important thing, unlike the past 10 years, I think we've come a pretty long way in terms of the strength of the country's fiscal position, monetary position, and the when you kind of look at the current account deficits or balance of payments situations are concerned, I think we've come a pretty long way. Services exports has emerged as a big contributor today, and to that extent there's a nice little strength that the economy is basically on stronger footing. Coming to the second aspect of it, earnings is again at a very interesting trajectory. The big change that we've seen is two things. One is we've seen post 2020, we've seen globally most economies moving from focus on a just-in-time sort of a supply chain to a just-in-case sort of a supply chain. What it essentially means is we are moving to a combination of supply chains. No more is it a single global supply chain. We are moving to a combination of local supply chain, friendly supply chain, and a global supply chain. So what this does is it breaks scale, and when you break scale, inflation increases because cost of producing those services or products increases. So inflation increases, which is why you've seen interest rates kind of settle at a higher level. So the second big change that I was alluding to is a outcome of the first one. There have been areas which have been underinvested for a fairly long time, which is what had come to hurt us in terms of higher inflation for a fairly last 2-3 years, as you can see. Which is why if you look at the US 10-year, for example, has moved from less than 1% to today upwards of 4%. Now, when this happens, there is no more free money on the table. So today there is nobody can give you freebies and discounts and create a new company. So if you have to today put up a telecom company in the country, you need at least about 3 lakh crores to put in a new telecom company. If you have to put up another Zomato or Swiggy, you need a hell of a lot of money. There is no more free private equity and venture capital which can borrow money in Japan at close to 0%, lever it up, and deploy it here, create the returns, and create an amplified return on the leverage. That is simply not possible because there is cost of money today. So as a result of that, you're basically seeing that there is no more loss funding which is there. Everybody is wanting to be profitable. Now, when that happens, the ROEs are trending upwards in overall as an economy itself is concerned. And that's a great place to be after a fairly long period of time. In the country, we are seeing the listed corporate space delivering in excess of 15% ROE. This is the zone of value creation, as we like to call it. So that again is in a pretty even keel. Now comes, so overall from a economy and earnings part of it, things are okay. But the only aspect where emotions is the other part that we need to tackle, which is where the art part of it really comes into play. And when you kind of look at that, what you've historically seen in the Indian markets is that can anybody take a guess that in the last, say, let's say 35 years, how many times has the markets corrected by more than 20%? You can give a ballpark number. Sorry? Okay, that's a decent guess. Sorry? 12 times? Okay. 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 It's almost about 32 times. Okay. So we are almost once a year, you have a 20% correction. How many times have we had a 10% plus correction in the last 35 years?
100 plus, twice as much. 100 plus.
Yeah, 100 plus is a very close number. It's about 108 times. Okay. Now, can anybody tell me when was the last time that we had a 10% plus correction? Yeah, it's about 2.5 years back. Okay. And when was the last time that we had a 20% correction? I'm guessing all of you would know it's the COVID period. So we've not had a deep correction. Now, here's another one. This is a very interesting one. If you invested in 2007 end in the small cap index in the country, how much was your money worth in 2020, January? Sorry? 30 times. 30 times, okay. It's actually 0%. You just got dividends. Okay. So, what you have to do is, you have to understand that you need to focus on the right set of companies. You need to focus on whether they're having earnings growth, they're having ROE improvement, and they are available at a decent risk reward. Just taking a blanket strategy doesn't work. But that said, in every year, here's another data point. If you take a 5-year bucket, any 5-year bucket, rolling basis, and let's take a 15% plus CAGR returns stock-wise. Out of the NSE 500, in the worst 5-year bucket, how many companies do you think have delivered more than 15% 5-year CAGR? Out of 500. No, that's 200 is being very benevolent. Okay, that's about 77 is the number. No, if you go look at the index, Nifty small cap index, you will see that it's 0%. Sorry? It depends on the fund. It depends on the fund, so you can go and look at each of the thing, but at a category level, people have done decently well. Now, coming back to the point on that particular data point, if you take a 5-year bucket, the least number of out of 500, how many companies have delivered 15% 5-year CAGR? That number is about 77. The maximum is about 335, which effectively means if you take a 5-year view on a rolling basis, you're landing between 15 to 70% of companies giving you this kind of a return. Okay, so that's the more important point that I wanted to leave you with is the sense that companies create wealth, not markets. While markets help and the tailwind is there, you also need stock selection and a bit of research to back you up with identifying that ideal set of names. This is what we've tried to do. We've tried to keep things simple by following our BMB philosophy, which is business management and valuations. And that's really kept us in good stead in the long run. But that said, you will have short-term volatility. The only way to go around that short-term volatility is, I think I've kind of covered most of these slides. I don't know why it's not up. Yeah. So the only way to work around. Okay. So yeah. Yeah. So the only way to work around this, entire phase is, take a slightly longer term approach to it and do it in a more systematic manner. So you have to have both an art and a science, which is where the help of a large research team really helps. And more importantly, please periodically do asset allocation. Do not think equity is the only asset class. Do not think equity is the only asset class. Periodically, please do your asset allocation. If equity on valuations is expensive, then allocate less to it. But that said, what I'll also leave you with is, we are comfortable managing money if you have a 4 to 5 year plus view. We think we can give a good investment experience on the basis of the various processes that I kind of outlined with. But only thing is, consider us only for the equity portion of the money, and because it is HNI and ultra HNI clients, only the aggressive part of their portfolio. Okay, so that's broadly what I would kind of leave you with. This is how we've approached, working around volatility. Volatility cannot be wished away. The one thing that you have to guard against is differentiate between volatility and risk. Volatility is a friend. It allows you to participate in great companies from time to time. So when the opportunity comes, it allows you to participate if you have missed it in the previous cycle. Whereas risk is permanent risk to capital. That is what we want to avoid, purely by having our research team and the research strength to help us navigate that. That's broadly what I'd kind of leave you with. Any questions?
Yeah, I have one question. Like when you say it's alpha investment and you talk about the PMS and all. So first thing is that how to find which PMS is good, and the alpha what you generate, how much? I mean, there should be some value.
Okay,
no?
so here I'll have a slightly more philosophical answer. Asset managers like us are like pharma companies. Advisors, people like PMS AIF World are like advisors, or people like you also who advise are like doctors. And the investor is like a patient. What is good for each investor or the patient, only the doctor knows. So that's what the doctor needs to do. We manufacture good products across. Depending on what the investor needs and the advisor finds it suitable, they can recommend accordingly. There is no straitjacketed answer, because what is good for one person is not good for another person. Because the investment needs are also like medical needs. It's very tailored. It's not a one-stop solution.
Good morning, sir.
Yeah.
So you mentioned as asset allocation and the previous cycle, like the past cycle. So do you mean that the cycle is saturated now and the market is where like you have to look into the debt? Or if I'm trying to invest equity for the first time, rather than like from the mutual fund moving into the HNI perspective, if I want to put in a lot of money into it. So do you think that this is the right time, or we have to still look into the debt first and then look for the market corrections?
Okay, so depending on your investment horizon and your investors' investment horizon and your risk appetite, my sense is there are different asset allocation models. Typically, most would kind of vary between, say, a 20% to 80% equity. So if you are today finding the markets expensive, then you could allocate 20%. But if your asset allocation model says you're at the stage of life where you can take slightly more risk, then probably that number could be 30% or 40%. So that's again a very, very individual specific answer. That said, today if you look at the market at an index level, like the booklet that has kind of been given, I think that page number 3 I think has the valuations. You will very clearly see that Nifty 50 PE is somewhere around 23.7 or so. The mid cap PE is upwards of 40. The small cap PE is somewhere around 30. But does that mean within these market caps you don't find enough companies with the right risk reward? Absolutely not. If you do enough work with the kind of research bandwidth, then you will be able to find companies. But that said, versus history, the valuations are slightly on the higher end. So ideal thing to start off with is give yourselves a bit more time if you still want to do equity, and give it lower allocation probably at this point in time. And then once the opportunity comes, then keep deploying more. That's historically what has worked.
But since the investment outlay from our end into the PMS or the products that you guys have, so I might not able to churn in more money into the investments from the business. So I might not be able to average it out. So in that perspective, if I have to go right ahead and start the portfolio first and then can look into it 2 years down the line to invest further down, or wait 2 years and then invest?
Then you'll have to probably wait, because then that it doesn't suit you, right? So you'll have to wait, you have to work with that.
So that means that the market is at the rate like it's not that conducive to the first investors.
Again, there is no one straight answer. Okay. So if you give us money for 5 years, we are still taking money and we are still able to manage. But I can't say that for every asset management company because I don't represent everybody.
That's true.
Okay. So for us, what I'm clearly telling our investors is, if you're coming in today, please come in with a more longer term orientation and do the asset allocation and come.
The long term,
once you give the money, we are not running cash calls.
Correct.
Because if I do a cash call, then I am undermining your effort on the asset allocation. So that is not right. Ideally, we deploy between 1 to 3 months once the money comes in. We don't run more than 5% ideally, on an average. Around that. Sorry? Okay, so we run at different, people when they come in at different points in time, we run differently. So if somebody's come in 5 years back, their portfolio is different. People coming in, say 1 year after that or 3 months after that, it's different. From time to time, we keep aligning, depending on, because there are certain names which come into the model, certain names which go out of the model. But because of tax purposes, we don't immediately book profit in everything. We allow it for the time. Only when we have a slightly better relative risk reward in another name, we make that switch. That's why our churn levels are also lower. So, sorry? No, specific will not be possible. I'm sorry.
So you mentioned about emotion and arts and how do you cater to that. So how does it translate from a principle into action? So is there a tool, methodology? Like, how does that translation happen?
So that's where it's both art and a science. So we have a 5-layer process from 2,500 odd stocks. We have a research team which is already filtered one level of 600 stocks. From there, we have our BMV philosophy, which is business management and valuation. Using that, that has multiple points, that has almost 30 checklist points. We use that, bring that number down to about 140, 160 odd number. And from there, the 4th level is depending on which strategy we are running, whether it's value, contra, pipe, growth leaders or ACE, which are investment styles, or large cap, pipe, which are market cap based styles. Depending on what fits there into that strategy, then we make the strategy cut, which is the fourth level. And then the final level from that curated set, we build a 25 to 30 stock portfolio. Initially, when we build, it tends to be between a 30 to 40 stock portfolio. Over a period of 1 year, it becomes 25 to 30. That's broadly it. One last question.
One last.
Because what you mentioned historically also, the market has corrected 20% on several occasions. So, and it has been like on an average on a yearly basis, it has corrected 20%. So since the market is overheated now, and if it were to correct 20%, what is the kind of hit that your PMS fund is going to take?
See, I can't say one straight answer because different clients are at different levels in terms of this thing. What we've historically seen is our drawdowns have been lesser than the index, but there'll be periods where it could be higher than the index. But what we typically take an approach is 1, 3 and 5 year approach. In that phase, our track record kind of bears data that we've done well. So that's how I would kind of think at it. There's no one straight answer to your question.
Sorry,
yes, sir, your last question, yeah.
Yeah, historically what I observed is market has never topped out at 23, 24 PE. So one time it topped out at 27 PE, and I think in before COVID it was 31 PE. No, after PE. After COVID.
Yeah.
31. So
yeah.
Is it a reasonable PE now? 23?
I think the average number, if I'm not wrong, sits somewhere between 20 to 21 at the large cap level. Mid cap and small cap, we are way off the averages.
Yeah, mid cap is yes.
Yeah, so mid cap particularly is way off the averages. Small cap is still okay. So large cap is probably the better risk reward. How much of overvaluation can you predict? Difficult to call. So which is why it makes sense to be more bottom up. And whatever is the output is the output. We don't go in thinking that we'll have a portfolio with this kind of a PE and this. We go through a bottom-up approach and build a portfolio.
So what is the PE of your large cap?
Large cap is somewhere around 22.5, slightly less than the index currently. Yeah. Thanks everyone. Thanks a lot for the opportunity. Have a great day. Thank you.